All right, so why don't we get started? So thank you guys for joining. I'm Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. You can, of course, listen to our podcast, follow us on Instagram. We just broke 2,000 Instagram followers, which I guess is exciting. It's more than I personally have, a lot more. The other thing is our conference. Our conference is coming up on the 13th of October. We just released the agenda. I think it's a great agenda, but once again, I'm pretty biased. So it is focusing on you and trying to solve investment problems that you have. So everything from creating goals to selecting asset allocation to then investing in this environment. So you've sort of pivoted this from a lot of fund managers who generally pitch their book and talk about they're an Aussie equity manager, why it's so great to invest in Aussie equities. And we've sort of shifted it over to CIOs. So we have a couple of large industry fund CIOs that are coming in, and they, of course, have a more holistic and wider remit. So they can talk about what's going on and where opportunities lie right now. So anyway, I think it's a good conference. If you got our email yesterday, sign up or send me an email and I can get you signed up. But anyway, today we're going to talk about Fortescue. So we will talk about Fortescue. So let's take a little bit of a snapshot. And, once again, I think the purpose of today is really to talk about Fortescue and see if this is an investment, number one, that we think is a good opportunity. And number two, if it's a good opportunity for you, because as I say all the time on this, and we talk about all the time, is there are lots of different ways to be a successful investor. There's probably only one for you, and that involves picking things that help you achieve your goals. All right, so where are we at with Fortescue? Well, this is obviously last night's close. I believe it's down a little bit today. Pretty big sell-off in the market, but yeah, so what do we see here? Well, our analyst, and we'll talk about all the specifics, sees Fortescue as overvalued, so a $14 fair value, and it is trading for a little less right now, but 1842 is what it closed at yesterday. So let's dig into the company, why our analyst thinks what he thinks, and then, of course, if there's any questions I can answer, we will get into those. All right, so what is Fortescue? So Fortescue is a pure play iron ore exporter, and it's actually the largest pure play iron ore exporter in the world. It's the fourth largest overall. So what does that mean? It means all they do, and there's a little bit of an exception, sort of what they want to do in the future, but all they do right now is iron ore, whereas BHP is a company, for example, that is much more diversified. So not only iron ore, but they also have some coal, they have copper, and we've seen that in the news as they try to expand their copper output by buying Oz Minerals. There's nickel, so they're more diversified. Fortescue is a pure play iron ore exporter, and we'll talk about some of the ramifications of that. The other thing that's really important when we're looking at this industry overall, and we're looking at the iron ore portion of this industry, is that Fortescue has lower margins, and has lower margins for a couple of different reasons. Number one, Fortescue is a lot newer of a company, for lack of a better word, than a lot of the competitors, meaning a lot of the sites that they actually have where they're mining iron ore are newer. Generally, the way this works is you have to put big capital investments into sites initially, obviously, to get them up and running. And so the sooner that is, or I guess the closer that is to where we are today, the more those capital investments obviously are weighing on companies and weighing on margins. The other thing that's really important with Fortescue is their iron ore isn't very good. So basically, iron ore is obviously a giant ingredient into steel. They have lower grade iron ore. So what that means is that it's more expensive. If I am making steel, it's more expensive for me to use lower grade iron ore, and therefore I pay less for it. So Fortescue's iron ore sells at around, or has traditionally around, a 25% discount to the iron ore price that you see quoted. And so that iron ore price is based on 62% iron ore. Not that any of these details are important, but 62% iron content within what they are mining. Fortescue's is lower, so it's actually selling for a lower price. What Fortescue has done is it has increased production pretty significantly. So you can obviously see growing from 55 million tons in 2012 to 2022. So we've obviously seen a lot of, if we look at the share price and we look at revenue, we've obviously seen a lot of growth, and that's from that expansion of capacity. And that expansion of capacity happened during a time when iron ore prices were pretty good, which we'll get into. So like any miner, this is a China play. We can talk about some of the implications, but China is by far, well, not even, there's no other option, right? They are their largest customer. They sell practically all of their iron ore to China. And if we go back and we look at what's happened in China, as we're trying to figure out sort of what's going to happen in the future, but if we look back at why iron ore has been number one, so valuable, and why the prices have been so high, it's because of that demand out of China. And if we think about what China has done since, even if we go back to 1980, there has been this huge shift in China. And I don't have the stats in front of me, but huge shift from a very rural agrarian society into a urban society. So of course, what has that meant? That means is all these people are moving from some little village out in the middle of nowhere into these giant cities that seemingly popped up overnight. That's a lot of steel, right? All the construction that went into those new cities means a lot of steel. The other thing we've seen a lot in China is we have seen China trying to catch up to Western countries in terms of infrastructure. And so, and particularly when there have been any sort of economic slowdowns in China, the playbook has been, let's invest a ton in infrastructure. And so you've seen a lot of steel demand there as well. So the question, of course, we have to ask ourselves is, will that continue going forward? And over the longer term, our analysts think it will not, because basically we've already had this huge shift into cities. We do have a declining population in China, and the infrastructure has actually caught up to Western standards in terms of the amount of infrastructure per capita. So for all of those reasons, and we'll talk a little bit more about price in a second, our analysts see this kind of surge of demand that we've had, particularly over the past kind of 20 years, a surge of demand that supported these high iron ore prices as potentially going away. And then this last bullet point has caused a lot of excitement. And so what Fortescue has said is, from a pure play iron ore exporter, their strategy is to diversify into still an iron ore miner, but also a clean energy company. So we've heard a lot about that, particularly hydrogen. There's an article in the AFR talking about some of the investments Western Australia is making into hydrogen infrastructure, and really sort of going along with this clean energy, lowering emissions trend that we seem to be going into. So right now, they are making basically no money from this, but what they're doing is they're investing a lot into it. And so they're investing something like 10% of revenue into this kind of future Fortescue. So the question over the longer term, even if iron ore prices back off, is, can they generate enough profits from that iron ore to invest and shift the company? And, one thing I would say is that is difficult to do, because obviously when you do one thing and all of a sudden you want to change the company to do something else, that transformation can be hard, but of course it can work very well if you pull it off. All right, so let's talk about a moat. So with every company, obviously, once we understand sort of what they do, we want to look at, do they have a moat? So a moat is a sustainable competitive advantage. And why do we want that as a company? Well, of course, we want that because there are a bunch of other miners out there competing with Fortescue. And with every company, that's why we want an economic moat. We want that economic moat to protect two things. We want it to protect the margin that we have. So basically the difference between what we sell something for and what we make, top line and bottom line. And we also want it to protect our return on invested capital. So when we invest more money to grow our business, we want those returns to be significantly higher than what it costs to source that capital, which we call the weighted average cost of capital. So We do not believe, as you probably read on the slide, so maybe I should have done this before flicking the slide over. We do not believe Fortescue has an economic moat, and there are two different reasons for that. The first reason, and this applies to the industry, that miners are price takers. So what does that mean? Well, it simply means that whatever the price is of that commodity, they have to take that, right? There is very little, and they can adjust production, right? If prices are very low, they could decide, okay, well, we'll just turn down production and mine less because we don't want to sell it at that price. So that is an option, but they do have no control over their pricing. Whereas where companies want to be is they want to be in that price maker category, right? Where they can actually control. And truly a company with a moat is somebody that has more control over their pricing. So that's kind of where they want to be. And then the other thing, of course, when we start comparing Fortescue to other miners is, well, they have lower quality iron ore. So the implications there are, of course, number one, they don't get as much money as other producers that have higher quality iron ore. And it also means if the market starts changing, we'd have to see what those dynamics are. So at the end of the day, right, if iron ore demand starts falling off, then okay, are people even going to buy anything from them? They're even going to bother, even at a discount, this low quality iron ore. So it's just something to consider. And really, when we're looking for moats, is we're looking over the long term as the dynamics of an industry and the economy changes. How can companies keep that competition at bay? Well, having lower quality iron ore is not a great way to do it. The other thing that, of course, we have to look at is, and we talked about this on the first side, we have to talk about the cost, right? One of the ways as a price taker, one of the ways that you can have a moat, even though it's rare, one of the ways you can have a moat is if you're able to produce for significantly cheaper than your competitors. And of course, that's a huge advantage for you, especially as prices fluctuate, because you can still make money, you can still maintain a higher margin. And we think that there's a lot of cost, and we think that they are a higher cost producer, which is a problem. And so basically our analysts believe, and we'll look at a chart next that shows the iron ore price, our analysts believe iron ore will continue backing off. And we think the mid-cycle, and we'll talk about what a cycle is in a second, the mid-cycle estimate that we have is $63 US per ton. Now, if that happens, we think that Fortescue could be in trouble, that their return on invested capital would be below their weighted average cost of capital. Let's spend a second talking about what that actually means. So to grow a company, we, of course, need to invest in it. So in Fortescue's example, we wanted to grow the company. If Fortescue wanted to grow the company, they, of course, would invest in expanding production, for example. So really what they've done between those stats that we saw between 2012 and 2022. Now, that, of course, costs money, and we want to earn a return on that money that we're investing in the company. So very simply, if a company has a moat, we believe they'll be able to invest additional funds in the company to grow it at more than those funds cost them to get. So a very simple example, if you want to think about this in kind of a small business standpoint, which I think a lot of people find helpful, that if I'm going to go to the bank and borrow money at 5%, and I'm going to invest it in my small business, I'd like to make more than 5%. If I expand my business and simply make 5% on my investment, nothing's really happened, right? Like I've grown revenue, but I'm really not adding any economic profit. So all I'm doing is kind of growing for the sake of growing. And companies will generally keep doing that, right? Because there's a lot of reasons for a company to keep doing that, that companies like to grow. Obviously, there's a lot of people working on working for the company, depending on it. So there's a lot of reasons companies will do that. So we believe most companies without economic moats will eventually fall into that category, where they're sort of out there kind of churning the company, right? They might still be growing, but they're not sort of compounding that economic profit to shareholders. Fortescue, we think, could fall below that cost curve. So if iron ore prices dip to what our analyst thinks they'll dip. He's estimating that Fortescue will get a return on invested capital below their cost of capital, right? So now, and that you cannot do forever, because now you're actually losing money off of everything that you're investing. So that would be this example where I went out and got this loan from a bank at 5%. I was investing it and I'm earning 4% back. So that's a problem, right? It's a problem because I need to pay back that loan in my small business example. And yeah, that's just not going to cut it if I'm earning less than what I need to actually pay back the loan. So that is Fortescue's lack of moat, according to our analysts. And this is the iron ore price. So going back to November 2016 through, I believe, June was the last data point on this. So what you can see is there was this surge in 2021 of prices, and continued rather high. So what we're seeing a lot right now is we are seeing those prices play out in company reports. And just remember, and it's something that's really important and hard sometimes as an investor to remember, just remember that, any company that we own, we only care about the future. And of course, what we get reported is the past. So when you see these enormous numbers from Fortescue and other miners and special dividends and all the other stuff going on, that's great. And that's great if you're a shareholder, but just remember that reflects what happened in the past. And in this case, it reflected these very high iron ore prices. So just something important to remember. And what really matters, of course, is going forward, what will that price be? Now, our analysts think it's going to come back. But once again, obviously anything could happen, but just realize with these price takers, the impact of higher prices is really positive. Because literally that's just profit, right? Like if you are selling iron ore, in this case, for above the cost that it's going to take to dig it out of the ground, then literally every dollar that iron ore price goes up, that just flows directly to you, right? That literally just flows to the bottom line. Of course, the same thing happens if prices fall. Every dollar those prices fall is a dollar you don't have, because you've got that cost to get it out of the ground. And if it does fall below your cost, then you're in trouble. Then you have to make a decision. Am I going to keep, obviously I think you're optimistic about the future that things will change, but over the long run, you have to think, am I going to keep doing this? All right, so uncertainty. Now, this is where we want to start thinking about, okay, is this a share that is potentially right for me? So our analysts go and they rate the uncertainty rating, and the uncertainty rating is really them talking about what are the inputs that go into their fair value and how sure are they that that's going to happen. So the higher the uncertainty, the less sure or confident they are in their estimates for the future. Now, different industries and different companies have different uncertainty levels just by their very nature, right? The more sort of inputs and moving parts that are hard to estimate that go into a company's fortunes, the wider the range of those outcomes the company could have. So why does Fortescue have a high uncertainty rating? Well, number one, they're a price taker. So that means that if I'm an analyst trying to analyze Fortescue, or if you're an investor trying to or buying Fortescue, the number one driver is going to be the iron ore price. So you need to have in your head some sort of viewpoint about what's happening with iron ore. All right, if we go back to this slide, your viewpoint could be it's going to go up here above $200 a ton. It's going to stay at the same level. Everything's going to be fine. It's going to dip. You need to have some sort of directional view of where you think iron ore is going to go, because that's going to be an enormous driver for what happens with the company. So as a price taker, it's just another piece of analysis that you need to do as an analyst, as somebody investing in this company. So that's going to increase the uncertainty level, right? As opposed to a company where there isn't this supply and demand component to the major commodity that they're selling, where you can sit there and say, okay, and I always use Coca-Cola as an example. We'll use a different one. If you're investing in a beer company, if you're investing in Anheuser-Busch InBev, for example, like how much is the demand for beer going to change every year? Probably not that much, right? It might go down, and beer's kind of been in this little bit of like a structural decline where it's gone down a little bit every year as other drinks have become more popular. But the beer price or the beer demand is not going to drop by 50% next year, right? So whereas the iron ore price very much could drop by 50%, or it could go up. So if we just look at this this window between, when did this peak? So let's say this peaked in August. Like if we sort of look at this window, like it's a huge chunk, right? So even if we sit there and if we look at August, we're saying it's about $100. Well, all of a sudden it more than doubled in a year, right? That's not going to happen with beer demand. So that's why that's going to be lower uncertainty. Whereas with a price taker like Fortescue, it's based on one commodity, right? At least with BHP, you'd sit there and say, okay, we got to look at iron ore and copper and nickel and coking coal. With Fortescue, one commodity. So that's why there's a lot more uncertainty. And so if you were to go out there and kind of look at, okay, what is a company that is most leveraged to iron ore prices? It very well could be Fortescue, right? They don't sell anything else. Or they don't mine anything else. So very, very dependent upon iron ore. So if you're going to invest in Fortescue, you should have a view on what's going to happen with iron ore. And if you have a view on what's going to happen to iron ore, you need to have a view with what's going to happen in China, because they, of course, are driving all of this demand. A longer term risk that we have, and we'll get into some of the geopolitical sides of things in a second, is that low-cost iron ore from Brazil, where there is already, a lot of iron ore being mined. Now, there was that, dam disaster, which wiped out a lot of the supply temporarily from Brazil. But we've got Brazil, and then there is Africa. So anyone who's picked up a paper and read about what's happening in Africa, there is a lot of Chinese investment in Africa. And a fair amount of that, of course, is because it's a very mineral-rich continent, and they are looking to diversify where they get iron ore and all the other minerals that are going into the Chinese economy. And the other thing, of course, you read about in the paper is geopolitical tensions between the West in general and China, and also Australia and China. So you can bet that they are they're very dependent, of course, on iron ore coming from Australia. You can bet they want to diversify where it's coming from. So those are sort of longer term risks. Now, on the plus side for Fortescue is our analyst believes they have a very strong balance sheet, as long as, and he actually writes this in the report, as long as a decision is not made to go out there and borrow a bunch of money to invest in something, right? So right now, what they're doing to try to move into, diversify the company, move into some more green energy initiatives, they are, of course, investing money that they're making out of the business. The other alternative is they could go out there and try to speed that up by borrowing a bunch of money, buying a company, or borrowing money to invest. And the reason they've been able to funnel a lot of this money into those initiatives is, of course, because they're making a ton of money right now. But a strong balance sheet, the strong balance sheet that they have, is a plus. Because, right, if we are analyzing a company in general and they have a very weak balance sheet that's very precarious, that's another input into the analyst model that's hard to predict for the future, what that impact will be. All right, so to kind of sum up, and this was fast, obviously, if anyone has questions, I really like this bull versus bear case part of our analyst report. So let's go through some of these different arguments. And what I like about this is because, whether you own a share or not, or whether you're considering buying a share, it's very important to see the other side. All right. So whether you're sitting there right now and saying, all right, I think Fortescue would be a terrible investment, well, let's look at the other side. Why could it be a very good investment? Conversely, if you own Fortescue, you should know those bear arguments and you should understand, okay, what could go wrong? Because that will actually, we obviously have this bias to sort of this confirmation bias that we kind of go out and just find people that agree with us. But it's important to also see the other viewpoint. All right, so what's the bull case? So very simply, as I was talking about, strong leverage to the Chinese economy. All right, so if the Chinese economy continues to consume and produce a lot of steel, very good for iron ore, right? That's really what has led to very high iron ore prices in the past. So once again, so we're talking about this is a China play at the end of the day. They are the largest pure play iron ore company. So what does that mean? That means if the prices stay really high and demand stays really high in iron ore, just as BHP, for example, gets benefits from being diversified in terms of risk on the downside, if iron ore prices are very high, who's really going to be the main beneficiary? Not the main beneficiary, but where is those iron ore prices going to have the biggest influence on a company? It's going to be a pure play company. So while BHP certainly has and will benefit if iron ore stays high, Fortescue as a pure player is really going to be a disproportionate benefactor. The other thing, of course, so steel industry margin. So basically, we're talking about the steel producers now. There could be changes in this discount that Fortescue is getting. So, there is no set. Iron ore is obviously something as a commodity where there's a set price, but there is no real set discount that you get for inferior iron ore. So, yeah, if these product discounts narrow, if they get less, then all of a sudden their disadvantage that we talked about narrows. So that's another bull case. If we go over to the bear case, and I would say the bear case probably aligns closer to what our analyst thinks, that this fixed asset investment, so basically that's building stuff. So whether that's cities going up, giant infrastructure investments, if that slows, and we think it will, then iron ore volume and prices will fall. So that's a problem. We talked about how Fortescue's margins are lower than some of their other competitors. So if iron ore prices fall, of course, remember that directly impacts their margin because that's the nature of being a price taker, right? So they've got these mines, they're out there mining iron ore. It's not going to get it significantly cheaper for them, right? So that matters. And then finally, as we've talked about all the time, so it is 62% benchmark all the time that they do have an inferior product. And so that discount continues to persist at the level it is, or even potentially expands if volume, iron ore demand slows, then that could be an issue. Okay, really good question from Kristen. What would be the bull and bear case for the hydrogen aspect of the business, acknowledging this is largely a vision still? Yeah, I mean, I think the bull case for that is obviously, what is happening in the world right now, we are going to go through and, I think a decades long transition to a greener economy. And that's the bull case, right? At the end of the day, we sort of all know we are getting there. There are arguments about how fast we're going to get there and, what sort of sacrifices either we're going to have to make with higher energy prices or all sorts of arguments around that. But there really aren't many arguments out there that this is not going to happen. I think a lot of the arguments are about the speed with which it's going to happen. So, particularly with hydrogen, there are a lot of people, including, as I said today, go look at the AFR and look at the investments that Western Australia is making and to prepare for this. There's a lot of people that think that this is one of the answers to the world's energy needs going forward. I think the bear case is that, as you pointed out, Kristen, is that this is still an emerging technology or emerging space, which basically means at the end of the day, something better could come along. And we see this stuff all the time. And I think it's underappreciated just how fluid some of these sort of future energy needs or anything else actually are, right? So, if people are as old as I am, like you go back and you look at, there was a time where there was beta and VHS. There are times when we're supposed to all use Bluetooth players or all these different ways from an entertainment perspective that we were supposed to consume content. And it was all supposed to be this cutting edge technology, DFDs, whatever. Well, now look where we are, right? We all just sit there and it just gets streamed into our television through Netflix or anything else that we use. So the only thing I'd say the biggest bear case is that new technology could be invented, that new technology could replace things that right now we see as very viable sources of energy. So yeah, that to me is the biggest bear case. And I think that and we see this a lot, I think, with electric vehicles as well, particularly around lithium, right? That we've all sort of decided that, okay, electric vehicles are going to take over. And the current battery technology, which heavily relies on, certain metals to go into it, like lithium, will be what powers all these electric vehicles. Well, we don't know 10 years from now, right? There's somebody out there that is creating a battery that doesn't use lithium, right? There's somebody, and will that take on? Will that be mass produced? We have no idea. But with any of these emerging technologies, just realize there is an alternative. There's some alternative out there, and you have to analyze, in this case, is their approach with hydrogen going to be the one that catches on. So we do have a question. Sorry, I'm just looking up the answer because I read it in a research report, and now, of course, I'm forgetting it. So a question about Iron Bridge. So basically, Paul's asking about Iron Bridge, where he's saying that's actually higher quality iron ore. So that is one of their mines. Let me just find it in here. Yeah, so Iron Bridge producing iron ore, and I'm reading from our analyst report now, with an iron content of 67%. We estimate it will represent around 15% of mid-cycle earnings before interest and taxes. So basically what they're saying is they're looking at how much this one mine that they have is going to contribute to their overall output. So Arianas goes on to say, we assume that Iron Bridge will earn a premium of around $15 to $16 US dollars per ton above our assumed mid-cycle 62% benchmark price of USD $60. So what he's saying is, because 62% is the benchmark, because this iron ore that comes out of this mine is 67%, that they'll actually get a higher price than what we have. Although our analyst writes, however, with unit costs around double those of the company's conventional mines, we don't think it will generate return on invested capital above the weighted average capital for at least 10 years or so. So basically what they're saying there is, right now the cost is a lot more on this Iron Bridge mine, and it will take a while to get those production costs down. So there you go. Hopefully that helped you out, Paul. All right, well, we have no other questions. So I will, oh, we just had one come in. Every time I say we have no other questions. Good question. So we have a podcast listener. Let me pull up that report. Sorry about this. Here we go. So when we talk about moats in the mining industry, we did do a podcast where we talked about Fortescue, and we talked about the only moat that we have in in Australia on a miner is on doTERRA royalties. So basically, we have a wide moat on doTERRA royalties. And the question was why? So basically, there are two different reasons. So anytime we put a moat on something, we have a moat source or potentially multiple moat sources. So the two we have on doTERRA, so the ticker symbol on that, if anyone is interested, is DRR. So the two different reasons we have a moat is number one, intangibles and cost advantages. So basically, what the intangible relates to, and so remember, an intangible asset is something that is off balance sheet, something you don't see. Tangible asset is on your balance sheet. So basically, it's this royalty agreement. And the royalty agreement is with BHP, and the agreement sets out royalty payments for any iron ore produced at this mine, and then additional payments if they can increase mine capacity. So basically what we're saying is there are very good terms in this agreement, and we consider that a source of moats. And then the other thing is cost advantage. And basically that is just because of how cheaply the iron ore is produced in this royalty agreement. So that gives our analysts a lot of certainty about the cash flows, and then can look at those cash flows versus what the cost is. So hopefully that helped answer your question. But yeah, you should read the research report. It's very detailed about that source of economic moat. Okay, so we've got a question. Anthony says, what time cycle do you see iron ore price retreating to your target, or rather FMG share price retreating to around $14 or $15? So yeah, that is a mid-cycle estimate. So basically what our analysts are looking out and trying to figure out, okay, all resource companies are very cyclical. So at the end of the day, the way a lot of resource companies work is that high prices, of course, cause investment in expanding capacity. That expansion of capacity, of course, will make prices come down. And then people stop investing in expanding capacity and prices will go back up. So that's really what they mean by cyclicality. So when they say mid-cycle, they're trying to say over the long term, what do we think the average price would be, right? So there can be part of the cycle where the prices are very high, as I talked about, part where it's really low. So the estimate out there is, sorry, I'm just looking for the exact time frame that they have in here. Just give me 1 second. It is a very good question. Yeah, so basically 2026. So the assumptions that go into our report is we continue to assume iron ore averages $110 per ton from 2022 to 2024. Then we assume it starts retreating, and by 2026, we would see it at $60 a ton. So there you go. Hopefully that answered your question. All right. So now I think we're out of questions. I'll be back on Tuesday doing this again, obviously different topic, and I'll do it from Thailand, which is exciting, mostly for me, because I'll be in Thailand. But anyway, you'll have a different background without all my coworkers walking about. All right. Well, thank you guys for joining. If you have any questions or those conference tickets, if you like a discount to our conference, email me at mark.lamonica1@morningstar.com.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.